All right. Well, welcome everybody to Shop Talk. I'm your host, Dean Halonen. The CRO of Steelhead Technologies, and really what Shop Talk is. So this show is for those who have dedicated their livelihood to the craft of manufacturing, because those people understand the manufacturing environment, no matter what role or what seat you're sitting in, is oftentimes the hardest job in the world in terms of the pressures from customers that want parts faster, or operators aren't always showing up, or they're leaving to another industry or another company for an extra dollar. There's material prices going up, there's tariffs, there's wages, there's equipment failures and reworks and productivity. So that's typically the focus of today. But today we actually have a new guest. So kind of aside from the daily firefighting of problems, well, I guess not really aside from it, but bringing a new perspective into it, is our guest today is John Mosser. So we're happy to have John Mosser on the show. He's the founder of Triscend Partners, and it's based out of North Carolina. And John's actually worked with quite a few job shops around the country, moving them from where they are today and getting them into a successful exit. So really, that's his goal, is connecting great companies to great buyers and getting a great outcome for both parties. And so yeah, John, thanks for joining the show. We're very curious to hear your perspective on the industry that we live in. We're typically in the trenches. We don't often look up and see the high level picture. So I'm pretty curious. But maybe to start it off with, John, would you mind going into your background, maybe even briefly where you grew up, how you grew up, and then how you got into manufacturing?
Yeah, absolutely. And first of all, thanks for having me on, Dean. Looking forward to the conversation as well. So I grew up in the Raleigh, North Carolina area. Kind of moved away for a couple of years, down to Georgia, and then back to North Carolina, and graduated from App State in North Carolina. And from there, I really started my career actually with an accounting firm doing valuation consulting. So got an interesting foundation and a lot of academic-based approaches to valuation starting my career. But then after a short while, moved on to an investment bank in Richmond, Virginia, where probably 80% of the work I did was working with family and founder-owned businesses, either raising capital to help them grow or to help them formulate a succession plan. Um, Fast forward a couple of years, you know, had some personal family health issues that drove me to back to the Raleigh Durham area where I'm based now, and was fortunate enough was the first kind of dedicated M&A hire with a company called Chimera International. Chimera was a private equity backed company, and they're in the materials space. And part of our growth thesis was how can we grow the company into more value-added spaces. And being in the materials industry, one of the ways to do that was vertical integration and what types of coatings can we apply using our materials. So spent a couple of years there, really in the trenches with some of that R&D and engineering folks, really understanding the types of processes, how some are related, how others aren't related, the types of materials and environments that different components are in, and the types of materials that have to be used. So there, traveled around North America and Europe looking at different acquisition targets, really understanding the industry. But after a couple of years, uh, I tend to be a lot more passionate about working with family and founder-owned businesses rather than a larger corporate environment. So found there to be what I perceived an interesting gap in privately held companies in this market, really getting good representation when it came time to pursue an exit. And reason being because the space is extremely technical. There's lots of different, coding processes and technologies, understanding the types of materials that are used in different cases. One example is we'd be looking at acquisition targets, and if we were pretty laser focused in the thermal spray market, we might have somebody approach us with something that could be painting lines on asphalt. So being able to understand the links between the technologies and where things are a fit and not a fit. I felt like I was pretty well positioned to be able to, one, serve privately held businesses, but two, help to translate where things fit and they don't fit, particularly in this market. So I started Triscend back in 2023. Spent a little bit of time getting our systems in place so that way we can adequately, serve our clients. And kind of fast forward to today, and we're growing very quickly. Now up to a team of three folks, and pretty passionate about the space that we're in.
Yeah, that's interesting. So just to go a little deeper on the Chimera area, so that was they were a chemical provider and they wanted to vertically integrate with a coatings applicator. By is that the idea?
Yeah, that was certainly one of the theses that we had. So they make metal powders that are
Hmm.
oftentimes used in particularly uh, thermal spray, laser cladding, some types of welded processes as well.
Hmm.
So those, after we spent a lot of time looking and looked at building out really a coatings platform underneath Chimera, that's when you kind of branch out into other types of coating processes that, you know, that's when you get into plating and anodizing, powder coating, and the other things that your customer base at Steelhead's also involved in.
Yeah, cool. Yeah, it's one thing I didn't realize before getting in this industry is like there is like the need for integration is so strong. Like manufacturing is a team sport, no matter if you're a supplier to of a chemical or a powder, or you're the applicator, or you're the machine shop or the fab shop or the OEM. Like everybody has to work together quickly and efficiently in order for the to justify the supply chain being here versus being in Mexico or China or somewhere else. So that's cool to see like that vertical integration component coming through in your background. And then why the family business versus the more you know private equity typical private equity approach of or maybe more corporate approach that
Yeah,
others take.
yeah, I'd say that answer is probably pretty simple. I tend to just be much more interested in the story and the relationships, building relationships with folks. We take a very educational approach, and I think it oftentimes takes a lot of hand-holding when folks work with us. It's oftentimes the first and only time they'll go through a succession plan or a potential exit, and the private equity space can sometimes be a little bit more, transactional rather than what we typically find with our clients. And personally, I tend to enjoy that a little bit more.
Yeah. And on that side, so say I often think these family businesses pass down generation to generation. In many cases, it feels like the American dream, right? Where they started with nothing, maybe a one booth or in their garage, and you hear it all the time, working 100-hour weeks, brick by brick, building up something that's like it's their livelihood, it's their maybe their generational source of income, and then maybe the next generation doesn't want to take it on, so maybe that's when they reach out to John and say, "Hey, John, it's time for me to gracefully exit." In your experience, John, when is the right time for a shop owner to start, say, preparing their business for a sale?
It, I, I tend to say it's never early. It's never too early. There's always things that you can do from day one. And I think, having a perspective of at one point, I will want to pass my business on and need to pass my business on. And that can take a variety of forms, not necessarily just selling it. Maybe there's a member of the management team that would love to carry on the business. And that's where we can also help pair them with a capital provider. But really, I think very early on when you're formulating the strategy, just having a conscious thought of, how is this going to be perceived by an acquirer or an investor down the line? And oftentimes that's, doesn't take a lot of energy to really think about because generally if you're making moves, you're trying to add value to the business to begin with. But sometimes, there's ways that you set up the systems and policies that can potentially scale a little bit more. So, thinking about those things as early as possible certainly helps, but trying to make sure that you have a couple of clean years, typically 2 to 3 of, a pretty clean operating history, financials that are in order, making sure you really understand your business as well. Can't tell you how many times, we talk with folks and they're not always aware of exactly where they're making the most money or what's profitable and not profitable. So, having, I think in some ways it's somewhat simple, but, taking the 2 to 3 years before you think you might be ready to pull the trigger. And I think the timing is another thing that um, can play into that fact because sometimes it's really emotional and there's never a right time until potentially it's too late. So, I'd say never too early, but when you think you're getting closer to ready, I'd strongly advise, a couple of years, 2 to 3 ahead of time.
At least 2 to 3 to make sure the books are clean and in order and there's systems and processes in place. So I guess there's two things there. I like to say the systems and processes side and then the profitability side. Um, do you have an example that come to mind of um, like what does that actually mean in real life? Maybe we'll start on systems and processes. Are you saying like the owner or the operator has to walk away and the business has to perform, just as good without the lead owner in the trenches? Is that what you mean? Or is it like we actually need like a documented process for how we handle every potential workflow? Or what does what does like great systems and processes look like from your perspective?
Yeah, so to answer the last part of that first, I've a really good case study that I don't really want to name names, but we worked with a company that was in the coding space. They knew, okay, we want to pursue other interests. It was a father-son combo, and they wanted to do something else. So they made a conscious effort about 3 years in advance of when they thought they'd be ready to sell the business to they implemented an ERP system. They made a couple really interesting investments to vertically integrate on their side. So not only performing the codings, but also, you know, the post-process finishing. So as an example, um, implementing technology, they did a very simple but effective development for their post-finishing and deburr process, where typically every coding cell had to go through a very manual deburr, and it had 3 people, per coding cell. They made the conscious investment to try to automate that on the front end. That was going to significantly improve their margins. And it wound up being, it wasn't a super expensive development. They used kind of existing technologies that are out there, but integrated it into their process to where each coding cell could then operate with a cobot and only required one person. They also got the benefit of, okay, we drastically improved our safety profile from an insurance perspective. And now we don't have the risk of people cutting themselves on the sharp edges. This part is automated. So it was a good, example of an area where they identified a couple key things that they can really execute on within a 12-18 month time frame and improve their profitability by more than $500,000 a year. That was one piece. The other piece was they went out and found a dedicated general manager that could kind of come in, really understand the business, be hired to replace themselves. So that way the business, has got a good management team in place that continues on. I think that that's a great success story of someone who, they had a plan in place and they executed to that plan. Um, but I will say, that's not always required. I know, circumstances come up and people feel like they need to sell earlier. And when that happens, there's also very successful use cases where, people can still exit even if they're still very integral to the business. But when that happens, you typically find those are instances where they'll see offers that have a bit more structure to them, where it's tied to They ask you to roll over significant amounts of equity. They ask you to finance part of the business. They'll hold certain amounts of money back to make sure that the key person is still employed for several amounts or for several years. So I would say that the first instance I shared, very successful use case where I think, they maximize value and cash up front. The other end of the spectrum, it's not to say you can't still be successful in going through a sale process, but it's probably realistic to expect a little bit more structure to what your transaction might look like.
Yeah, it's super interesting. And the also even without selling the company, your example of using clever automation to boost your margin profile and reduce your safety exposure, um, is fantastic even without selling the business. So that's the one thing that I wouldn't say I necessarily obsess over, but probably half of what I obsess over is just profit, pure like because it takes everything coming together, right? Great hires on the GM side, great automation, great, ideas, great execution, great customer service, great, like everything truly has to come together for the profit. And on the profit side, maybe if you could explain to our listeners, John, like there's profit obviously has a lot of um, different form factors of like net, right? Profit or gross, net margin or gross margin. You also have the EBITDA, which whenever I read like a merger or acquisition, it seems like there's an EBITDA multiple. So maybe if you could pretend we're all first graders here, and you could explain like the whole profit scenario and how it translates to EBITDA and how that translates to a valuation.
Yeah, absolutely. So I would say, first of all, this is pretty generalized, and there's always caveats and
Yeah.
complexities for each situation. But EBITDA tends to be how most businesses are valued and spoken about with a multiple. And EBITDA is used sort of interchangeably by investors and acquirers to represent the cash flow of a business. And really, what investors and acquirers are pricing the business off of is what is the sustainable cash flow of the business now, but even more importantly, going forward when we potentially take over. So the components to cash flow that are missing from that are CapEx and investment that's not factored into EBITDA or working capital. And oftentimes those can be significant parts for business in this space as well. But as a general rule of thumb, you know, EBITDA is generally can be thought of the cash flow that people are pricing and using some kind of multiple to get to the enterprise value.
Yeah. And what is working capital exactly?
So working capital, when I say that, I mean, your receivables, so sales and customers haven't paid you yet, the inventory. Oftentimes we don't see inventory as necessarily being a huge component of the working capital, unless you're in a much more materials intensive piece and you have to carry some of those materials on your balance sheet. Um, like let's say you have a really important chemical that's hard to get your hands on, but it's required for a coating that you're performing. In that case, we could see it being a much larger component. And maybe you have to, it's not necessarily profit, but you have to spend sometimes hundreds of thousands, if not millions of dollars to secure that inventory upfront to even be able to perform the work in the first place.
Yep.
So those are really the two things I'm referencing when it comes to working capital.
Got it. So in a way, EBITDA and net profit are for our customers, at least for the metal finishing job shops out there, they should be, as long as they're not making any massive um, investments in capital or they have massive amounts of inventory, the EBITDA and their net profit or net margin should be pretty similar then for a given year.
Yeah, assuming there's no investment and the working capital is pretty steady, then yes, absolutely.
Right.
Um, on the capital investment piece, that's why, I think it's interesting when you prepare a couple of years in advance because you can really drill down on that investment and say, well, what's the return I'm going to get from this and the value I'm going to add to the business? because automation is a pretty, popular word right now, and you see a lot in the news about it and AI. But we tend to see in this business sometimes that can seem daunting because then you think, oh, it's going to take a lot of time and millions of dollars to implement something. But we see a lot of companies doing really interesting things that add automation, but it doesn't take months and years of investment to implement or realize a return. So, I think that CapEx can really be tied into valuations when you prepare in advance because we can make some pretty drastic improvements to our business in that short time frame.
Hmm. Awesome. And then as far as the EBITDA margin or the EBITDA multiple, say for example, we're just a hypothetical, we'll say we're a $10 million per year revenue business and we're roughly like 20% on the EBITDA margin for like a $2 million of EBITDA per year. What is what would you say the multiple would be? Say it's just an average company. I know that probably doesn't exist. Or say it's like a company where they have their systems, their processes, their margins, everything's just crisp, crisp, crisp. Again, like a $10 million business, $2 million of EBITDA. What's like the multiple spread that you could see like, maybe best case, worst case, or best case, good case that you'd expect, John?
Yeah, that's yeah, you really put me in a tough spot with that question. But I'd
And
say
this
like
we won't hold you to this. Just generally, like, what is I mean,
I'd
there's
say
a
on average,
ton.
like 6 to 7 times is what I would see, and that's like really generalizing a lot of use cases. I've seen it range as low as 4 times and as high to the mid to upper teens. And it's always tough because like the mid to upper teens, that what that looks like is a company that is probably above 40% EBITDA margins and they're spec'd into a very particular program, have lots of quality certifications, and you can see backlog and performance that gets you really comfortable out many, many years into the future. Um, so that's a rare instance, is what I'm trying to say.
Yeah. But it's good to know
Um,
like that does exist so people can shoot at that, right? Getting that, I think winning business where you have a proprietary chemical or process and you get spec'd into in this case, I think aerospace work or military work is the only time I've seen it. It becomes sticky and predictable, and then people are willing to pay more for predictable revenue than uncertain revenue. So
and
it's
and
good.
most businesses do not look like that. I will say, and that doesn't mean that they're any worse off than the other business. It's just it kind of purely comes down to, well, how are acquirers and investors going to underwrite this? So
Perfect.
yeah, the
And then
valuation conversation is always tough because it's so situational.
incredibly situational. But it's helpful to know like what is possible. Now, say I own a job shop, right? And I come to you, John, and say, "Hey, John, I'm looking to sell in 5 years." What is that typical process? What does it actually look like for a job shop owner?
Yeah, so on the front end, we go through a pretty robust, what I call sell side due diligence, which we want to come out, visit the facility, sit down, really understand the technologies that you have, um, go through the financial history, understand where you're at from a systems perspective. We do a pretty robust valuation as well as a marketing strategy. And the valuation includes very academic-based approaches, like a formal accounting-based valuation, but we tend to try to focus more on what we think from a market perspective, as that, I'm a big believer in that's what truly matters when someone's going to go through a sell side process rather than a more academic based valuation. And then two, from a marketing strategy, what I really mean by that is helping folks understand, well, where are we at today? What can we do between now and when you think you're ready to pull the trigger? And really, what are all your options? Because, like I said earlier, it's not just as simple as, well, it could be as simple as I just want to sell and walk away, but there's a whole variety of other options and things that they can pursue. And sometimes it's, well, I do want to pass it on to my family, but I don't necessarily want them to just pay me back with the cash flow over the next couple of years, as that's going to be really restrictive on the growth they can experience. So that's where we help to pair them with a capital provider that can support the existing team and also provide a more realistic liquidity event for somebody. So on the very early end, that's what we do, to give them a sense and an accurate read of where they're at and where we think they could get to. Um, and two, that's also a little bit self-serving for us because we're not a huge volume shop. We work pretty, in lockstep with the clients that we work with, and it also helps to establish alignment. We want to make sure that what we're confident we can actually do for our clients is something that they're open to and that will meet their expectations, most importantly. Um,
Awesome.
Once they get a little bit closer, though, that's when we go through, you know, we prepare a prospective buyers and acquirers list that spans globally. We write a very detailed information package that's sometimes custom tailored to different use cases. As an example of that, we could be approaching somebody where the coding processes could be very, really attractive to somebody and, provide more capacity to somebody, but it could also be positioned a little bit differently if it's an adjacent coding process, something that somebody doesn't have. So we go through that, spend some time preparing. Then once we launch the deal, we kind of, go through a two-step offer process. The first is what we call an indication of interest. It's a first round offer that really helps us to understand, okay, who do we think are the best fits and who should we spend more time with? Then we go through, sit down, meet the folks across the table that are really interested in the business, um, get to know them a little bit. We also do some reverse due diligence, make sure we're really finding the right partner. And then we kind of do a second round offer that folks have now learned a lot more about the business, and we expect to be what I call fully diligenced, or all the factors that they could potentially need to understand to make an offer about the business. We should have done a good job of educating them at that point. And then from there, it takes typically 2 to 3 months to closing. So if someone's ready to closing, I typically tell them the standard process is probably 5 to 7 months is typical.
Okay. And then on in the early stages, like say we're 5 years out, and you're kind of telling people the levers they can pull to, is there any very common like, hey, A, B, and C are the common things you got to consider? Like maybe it is the cap, cleaning up the books is one of them, and understanding the business is another. But what are like the common levers that you're always maybe telling people that they should do to help get ready for that 5 year exit?
Yeah, those are definitely two. The other big one is sort of what I touched on earlier about, how integral is the owner to the business, and do they have a successor in place? Another, probably the other big point I would want to mention is, thinking about 5 years from now, is the business growing or was it flat and declining? Like, have we done things to invest in the business?
Mm,
And sometimes that can be a challenging trade-off, as we've sometimes seen, you know, private business owners enjoy the benefits of being a private business owner and the cash flow generation. And other times, they're very focused on driving maximum value for the business. And that's sometimes an interesting trade-off. And so we help them to think through, well, growing businesses are more valuable than flat and declining businesses. So, we try to help them weigh the trade-offs, assess different projects that they're thinking about. How is that going to translate to value for the business? So that, and then just the successor that I mentioned, and making sure your team is well built out and dependable.
nice. And then on the reverse DD or the reverse due diligence side, what are you looking for there in terms of, or do you have an example of like a great buyer versus a not great buyer?
Yeah, and maybe rather than a great buyer versus a not great buyer, I'd say even more commonly, it's understanding the culture of the business and where is that team going to perform the best with. And that doesn't always mean it's the highest valuation either. Actually, the one of our most recent transactions, this is a good case study of this with Oris Noble. They don't actually do coating, but they do a lot of recycling from anodes, predominantly from the plating industry.
Mm,
And that was a good example where, it was a small privately held business, and the family culture was very important to them, and finding the right partner was very important. So as we got further down the chain, we actually took a little bit more time in that process, to have several meetings with folks and the buyer of who ultimately bought them. We planned a last minute trip to, we just felt like we didn't spend enough time together. So before Christmas last year, we flew out to Germany, and we sat down with our client and them, just nothing more than spending more time together. So, I oftentimes think it's really a better fit, but it's to make sure that you're really comfortable with the party that you're going to be partnering with and selling your business to, and where your legacy is going to be.
mm.
That's not, sometimes people care about that more than others. But it's typically rewarding when we have clients that want to take that extra effort and make sure they understand who they're working with on the other side of the table.
Yeah, it makes sense. I think a lot of times these owners or the people in the shop are spending 20, 30, 40, pretty much a lifetime with their employees. And I would say that there's probably some concern that some cutthroat, whatever person, corporation comes in and cuts half the staff and, moves the tanks to, whatever, a different state or country, right? There's probably some
It's
fear there.
it's typically a fear when people hear private equity. Private equity
Yeah.
can be a bad word sometimes, but especially for this industry, we've seen a lot of folks that we think really highly of and truly invest behind businesses, and don't take that approach. So that's why I think it's really important to understand who you're working with
Yep.
before you transact. Um, and how
Agreed.
important that is.
Agreed. And then the last question I have here is, um, I got actually two more questions. What do you see as the biggest challenges that owners face during that, say they are going through that sales process, or that sale process? Is there any common themes that owners like, oh, I didn't think about this, then, and now they're faced with some emotional or psychological or financial decision that they weren't aware of when they started?
Well, so definite, you touched on one, just the emotions in general going into the process, I think this has sometimes been multi-generation businesses, or it's been their baby for the last 20 years, and it's a roller coaster. And sometimes it's not uncommon to get calls at midnight like, oh my gosh, am I thinking about this the right way? And
Yeah.
it's very common. We see it, I'd say, with more clients than not. That's typically something that comes up. I'd say we try to avoid surprises, and that's why we take a little bit more time upfront preparing to really understand like what are the things that could derail something later in the process. But the emotions in and of itself, and we try to do a good job of, connecting our clients with prior clients or other people that sold their business, because they're going through the exact same thing that other folks have went through. And it can sometimes be challenging to talk about because it's also confidential. Um, but
Yeah.
connecting people together that can hear about, weigh the trade-offs, know that somebody else has been there before, can oftentimes be pretty comforting.
Super comforting, and that's one thing. So I work for Steelhead, and we're an ERP software for job shops, and that's the one thing I love about my job is that I mean I had a customer call from northern Minnesota, and just before they committed to using Steelhead, he's like, Dean, you have to understand, this is my baby, right? And and you better not let my baby fall. Is pretty much what he told me. So I mean, it's cool. It's not like we're selling paper clips and nobody cares. It's just a commodity. Like it is more than just a spreadsheet, and it's a cool thing to be a part of.
Yeah, you're contributing to that story and the value creation for them.
Yeah.
So
And on that last front, as far as customers that maybe have a digital system and their profits and their costs and their WIP and their inventory and their predictability, say they have a system that is entirely documented and all the key data is readily available. Have you seen that have a measurable impact on the buyer in terms of what they're willing to underwrite or how they're able to consider the valuation of a company?
yeah, absolutely. I think it helps with something as simple as just understanding the true trends of the business, not having to, I've seen instances where everything's just kind of lumped into one bucket and you have no idea what the trends might be in there, what customers are increasing, which ones are declining, where do we have a competing technology or someone that's stealing business from us. So just being able to have a good sense of the business mix and profitability, absolutely. But I think sometimes even more importantly, having the systems in place that oftentimes an acquirer's going to want to grow. So something that can scale and withstand that growth, I think is extremely important and a huge positive. Rather than having to come in and immediately having to spend a pretty big capital investment for a potential system overhaul,
Hmm.
that erodes value, that is value that an owner is not going to realize. Um, Not to say that they can't still sell their business, but having that already in place to allow somebody to scale quickly is, I think, a huge difference.
Yep, it seems like it's a game of reducing as much uncertainty as possible, whether that's with people or processes or systems or margin or customers or finishes or spec in. Anything we can do to lock things down seems to be a good concept at the exit juncture.
Absolutely.
Awesome. Well, John, we do have some questions from our live audience here. This will be published wherever you get your podcasts as well. But Andrew Kosowski mentioned day one is a good time to thinking about selling your business. So he's absolutely right and oftentimes ahead of the game. We do have a question here from Sandy Kaplan to John, and she says from your experience, what are the top operational red flags that immediately lower a valuation in a finishing shop, even if like the revenue is strong or maybe the growth is strong? Say you pop the hood on the business, is there any like common red flags that buyers are looking for?
I think a lot of those things come out in a tour of the facility, kind of seeing, well, how well invested is the operation and how, does the operation really break down if Bob takes off work today? Like, is this one person really critical? And then if he's out for a week, sick with the flu, like, can we not produce? And now our month is going to be down the tubes and we're having to play catch up. So is there dependency within the process somewhere? Um, and then I'd say, I've seen where safety issues um, certainly throw a red flag that we need to take a much deeper look. And that I'd say safety and environmental can be two flags on visits that, really spark. Okay, we've probably got some concerns here. Things looked great on paper to start out, but we really need to dig in on a couple of these spots where it's clear they might not be as buttoned up. So I'd say those three things between environmental, safety issues, but then operational redundancy, capacity, and just limitations or maybe cogs in the wheel, so to say.
Yeah, that's one thing that I don't see a lot of people talking about is the operational redundancy. Say we miss our plant manager leaves, or some key operator leaves. I actually used to work at General Motors, and whenever you're designing a component of a vehicle, there has to be redundancy, right? If one thing breaks and the car cannot crash. So,
I've seen some good examples of folks that handle like cross training really interestingly. Like there's one shop that I've seen, they have a QR code at every station so people can scan with their phone and then the SOP pops up and there's a video of somebody performing the work at that station. So if someone needs to step in, even if they might not have that's not a station that they typically man. Um, they have everything they need there to pick up and run with it.
That's a good point. I didn't even think of that. Then we have a question here from Gabby. Say you owned a shop, John, that $10 million shop we mentioned earlier. What would you do outside of the things we maybe previously discussed? Is there anything you would do to maximize value before selling that goes beyond what we already discussed?
It's a tough question I wasn't prepared for. I would say that I'm not so much that top of mind would be anything that I haven't already touched on. Definitely, maybe the thing I tend to see adding a lot of value is the more value that you can provide your customers. And
Mm,
when there's the technical capability to, solve new problems, develop new coatings that go from a development or conceptual phase to something that's commercialized is really, really special. And when people see that shops have that capability and that kind of depth from a technology perspective, um, that's something that's not, growth can come from a new avenue now of developing new work and creating a new market rather than, can we add capacity and do more of this work? Because we can always do that. But when I see businesses like that, I tend to think it's extremely special. And I would need another team to do that because I'm not the person that is smart enough and
mm.
capable to do that.
Yep, hire a chemist. Um, Great answer. James asked, do you find owners understand EBITDA, or do they typically work with external advisors or yourself to help understand this and prepare their financial reporting to make it reflective of reality?
It's, I'd say it's all over the map. Sometimes we have people that have never heard the word EBITDA before. And then, we've worked with folks that have been involved in M&A before and are pretty well versed in it. But usually I'd say, we go through a pretty robust, process there. And one thing I think to be aware of with EBITDA is you also want to present a credible business. I've seen plenty of times when people present, when I was on the buy side, present, adjustments and add backs to get to EBITDA that are not credible. And that can be a flag to acquirers that, okay, now, the profitability is not what they indicated is, and we really need to look a little bit closer. So I'd say typically we do a lot of education around EBITDA, kind of what's normal. We look at things at a pretty granular level there to make sure that what we're presenting will hold up in the eyes of an acquirer or an investor.
Awesome. And then Mark had a question. Can you talk a bit about minority recapitalization or growth capital as an alternative to an outright exit? And curious to know what options are available for an owner to consider. Like, say they don't want to fully step away, but they want to maybe reduce their exposure or ownership in the business.
Yeah, that's another interesting one that when owners are open to that, we love to work with them in that capacity. It's just another option that they can pursue, whether they go forth with it or not. But it's interesting because if maybe they don't want to sell or they want to keep the business or they want to keep the business in the family name, um, you don't have to wait to get liquidity. Oftentimes, most of an owner's personal wealth is tied up in the business. And it doesn't mean you just have to sell the business to get liquidity. You can take on capital partners that have varying degrees of how passive or active they might be in the business, but they can provide liquidity to you earlier on. And then you're also taking some risk out of some of your own personal risk of all of your money being tied up in the business off the off the table, which can sometimes be pretty interesting and also a way that can help, um, not necessarily strap the business if when you are ready to transition, the excess cash flow goes to providing the owner liquidity. Um, so I think another positive of minority position is there's a lot of interesting partners out there that can still bring professionalism to the business and additional capital for growth. That's not always giving up control. Now, taking on another partner is, still taking on another partner, and they're going to have certain rights to bringing on a minority, um, somebody in a minority position, but it's an alternative to where you don't have to sell 100% today, but say you sell 40% and can get that 40% liquidity today versus um, a full exit.
Yep. And then James had a question on, is there a shift that you've noticed from your early days, maybe, 5, 10 years ago to today in terms of what buyers are looking for in the market right now?
I'd say I wouldn't necessarily say a shift from a buyer perspective, but because there's a lot of acquirers all around the world that are interested in surface technologies businesses, and some of them have very different strategies. So, you know, I'd say from an interest perspective, that the type of buyer may shift depending on someone's particular niche, but maybe some of the other factors that I think have been playing on uh like a big factor right now with the tariffs and particularly with tungsten carbide. And I saw there was some news on this today as well that I'm sure will impact things some more. But there's shops that spray tungsten carbide and the price has shot up tremendously. To where it's been like kind of a new reset. And our company is able to secure that supply or the chemical to be able to coat it. And our customers, are they accepting the cost increase, or are coating companies having to, eat some of that margin there? So I'd say not so much as like a broader shift from an acquirer perspective as there is being conscious of just certain general, market conditions and how they're influencing particular businesses.
Okay. And then this one's from Dean, myself. I feel like, John, what I hear is I have a brother-in-law that works in HVAC, and like the HVAC world is just getting gobbled up by private equities, and it feels like every industry is having a lot of roll-up action, if you will. Why is that? Like, why is over the last maybe a couple of years, is it because there's like all the baby boomers are now retiring and there's no one to buy them, or is there something else at play?
That's definitely a general theme in M&A overall, but particularly in the coatings businesses. At a high level, they're typically pretty attractive to investors because they have good cash flow. Most are generally pretty good margins. They're easy to finance from a banking perspective. Um, doesn't take a tremendous amount of working capital investment or capital investment, some in a lot of cases. So just I think on the face of it, the coating industry has a lot of just good investment characteristics that tends to attract private equity.
Awesome. And then question from Andrew here: how much does existing debt um, impact or service a business? How does that existing debt impact the value or the view of a business when determining the valuation?
So from a buyer's perspective, they typically don't care about the company they're acquiring from a debt perspective, um, because they're going to be acquiring the business cash-free, debt-free. And when they submit an offer, they're going to give a business enterprise value. And as part of that, there's a purchase price. You keep the cash that the business has already generated, but they expect all of the debt to be paid off before they take over is the most common instance. So the one area where that can sort of get flipped is if the enterprise value is, of course, less than
The debt.
the debt, because then you know, there's a negative equity value then, and conversations have to be had.
Right. And so Andrew, keep taking out those loans and keep growing. And then And then Gabby has the last question here, John. And John, maybe you could type your email into the chat so people can find
Sure.
if job shop owners have more questions, they know precisely where to find you. But the last question here from Gabby is what misconceptions? So say you're new to the industry and you're like, hey, I want to partake in the American dream, or I want to buy a job shop off, Andrew or somebody else. What misconceptions do buyers often have about buying a certain business? Is there anything that maybe scares them off?
I'd say depending on what types of coding processes, some can be pretty daunting to get into, depending on how technical it can be, to where you have to have really tight, you know, knowledge and tolerances on the types of chemistry that are being used. Because a huge risk would be coming in and you maybe lose the key person that was knowledgeable of that chemistry, and now all of a sudden all the parts you're providing are out of spec and you've got a major issue. So I think, like I said before, this industry is oftentimes extremely technical in the types of coatings that have to be applied. So I think it's probably being humble and making sure if someone doesn't have that knowledge, you've got the right team around you, because it really is a team effort. I'd say that's a big topic that I've seen come up. And when private equity looks at businesses, they oftentimes, if they don't have that support, they typically are looking externally for operating partners that do have backgrounds in those spaces. So um, that's definitely a big point I would mention.
Perfect. All right. Well, thanks, John, for joining us today. And thanks everybody that joined live and for tuning in to Shop Talk and putting those questions in the chat. If you do have any more questions for John, or maybe you do want help in valuing or selling your business or buying a manufacturing business, please reach out to John at triscendpartners.com. And we appreciate you guys listening, and we'll catch you next time.
Thanks so much, Dean. Enjoyed
Thank you.
it.
Yep. Take care.